Good morning and welcome to the Killik podcast for Friday the 27th of November. It's been a slightly quieter week because of Thanksgiving in the States, but we've had the autumn statement in the UK, so there's plenty to think about there. The key takeaway is that we're still on track for the budget surplus of 10 billion by the end of Parliament. We're seeing improved tax receipts coming through because of better growth, and that's allowing financing a reduction in borrowing and gentler cuts. It was a mixed statement for banks. Negative on mortgage loan growth due to higher stamp duty, a rise of 3% on buy-to-let. And that's been balanced by more support for first-time buyers and house building because of the big chronic shortage of new housing. The key changes in terms of stocks during the announcement: challenger banks and buy-to-let house builders fell between 3 and 5%. It was also slightly incrementally negative for the leisure sector with their high wage bill to sales ratio, and that's compounded the effect of that 7% annual national living wage increase that we saw earlier in the year. Overall, the sterling GDP responded positively to the statement because of those higher growth forecasts. But we continue to be slightly nervous about sterling against the major currency blocks going into the Brexit uncertainty that we're going to see next year as we go into that debate in September 16. The house builders were the chief focus of the statement, and in general this was good news for the sector. So they extended the Help to Buy scheme by a year to 2021 and broadened its use to London. We've also had the Starter Homes Initiative and the Shared Equity Scheme. So during the run-up to the statement, we've seen some quite decent share price performance from the sector, certainly on the morning of the statement. That enthusiasm boiled over a little bit as we saw that the benefits of this statement will be very focused on certain areas. So we think social housing providers will benefit. We also think building material suppliers will benefit. And as I say, it's a negative for buy-to-let, and it may bid up some of the build costs because we've got a shortage of things like brickies in this country. So looking ahead for next week, it's a very quiet week for corporate results. On Monday, we've got Aberdeen Asset Management, which is a key stock for us. And then through to Thursday, actually on Friday, we've got Barclay Group. So next week, I think the key drivers for markets, there are three. The first will be the results of Black Friday and Cyber Monday. These are the biggest shopping days of the year for the US and the UK. What we've been seeing this year has been quite a big rise in the savings rate, which is something that we hadn't really expected because we thought those savings on oil would come through to higher spending habits, but that hasn't come through. So the Q3 statements have highlighted weak spending trends. So we've seen some profit warnings from certainly the department stores in the US. So continued caution going into these big spending days, but we think that you can still focus on brands. Brand performance has been very strong, and we also think that more spending is going to go through credit cards rather than cash, which will be good for our credit card positions. The next issue is the ECB policy meeting next Thursday. Further easing measures are expected. So as you can see here, the euro has been extremely weak going into these meetings, and that's as people have become more and more focused on the extent of the policy divergence between the US and Europe in terms of interest rates. Given we're at 12-year lows against the dollar for the euro, and there is so much sort of focus on this, we'd imagine that it's going to be a very, very dovish statement from Draghi on Thursday to see further weakness in the euro, and we might just get a little bit of a bounce back short term. The third issue will be OPEC, who are meeting on Friday. As you can see here, crude oil stocks have continued to climb over the year, and we're now getting to very high levels of inventories in the US. This is because OPEC are continuing to pursue their strategy of maintaining their market share rather than trying to stabilize prices in the market. We're going to see increased production from Iran and Libya, so that would allow OPEC to actually raise their quota again during this meeting, which would probably have a net negative for the oil price. However, we have heard more commentary coming out of OPEC about their concerns about how low the oil price is, and that's tangential to where we were last year when they said they'd be happy to see the oil price go down to $20 a barrel to take some of that excess supply out of the market, so they weren't the swing producer anymore. So that'll be really interesting on Friday to see what happens. So that's it from me. Thanks for listening. Have a good weekend.